Morning, guys. It's Friday, August 8th, 5:27 a.m. Central Time. Grain markets are mixed this morning. Brian Split is here. Brian, before we get into our first official story, I'd like to run through some stuff that you posted on X yesterday. First of all, look at this profile picture. Is that AI, or are you using my
No,
wife's skin products?
I went to a photographer actually a week ago today, and then he got me that
Oh,
headshot in my email Monday morning.
looking sharp as always. In any case, you had a series of charts.
Yeah.
Continuous corn looks like we tagged some support. Continuous rough rice, which we never talk about, but looks like we tagged some support long term. Same thing with soybeans. Same thing with wheat. You're seeing kind of a pattern here. So what do all these things combined tell you?
It just seems like a lot of our agricultural commodities are at some very good long-term trend line support, some value. So the continuous corn chart is basically the uptrend going back to the COVID lows. We had two distinct lows in COVID. One was April of 2020, then we had a secondary low in August that began an uptrend. That low that we had August of a year ago is right against that trend line, and then the lows that we scored here this week are right at that same trend line. So this is the trend that corn has been in since COVID. On the rice, it's another market that we don't talk about a lot, but it's a product obviously that we grow here. We've got a lot of farmers in the Delta that grow quite a bit of rice, and so I think there's viewers that think this is important. And so this is an uptrend that's been in place. I think we started this trend in about 2015 or 2016, comes across 18, 19, and so we're at the long-term uptrend on the rice market right now. The soybeans, this one I think goes all the way back to 2001.
Wow.
And, you could really draw that trend for the last 20 plus years. Even if you just kind of zoom in on the trend since August of a year ago, we had August lows and we had some December lows and we had some April lows, and so just over the last year we're operating on the same trend line. So again, I mean, these are just lines. It doesn't mean it needs to hold here, but I think just bottom line, we're at some very good long-term trend line support. And then when we look at the KC wheat, just the pattern looks the same to me. We had effectively highs that were made at the same price going back to that initial peak, and then we had a downtrend that came off of there, and then both of these was what we would call a descending wedge. So both of those lines intersect, and then we could tell that from that last descending wedge, once we broke out of that downtrend, we had a pretty sharp rally. So this doesn't mean it needs to happen right now. We could continue to consolidate here for another few months before eventually popping through and trying to find a rally like that. But I just think big picture, a lot of these markets that we talk about and look at every day are at some good big picture value.
Great stuff. All right, let's start the show. We'll get into our first real story here. We had a pretty nice looking week of corn export sales.
We sure did. New crop U.S. corn export sales were fantastic last week. Weekly net new crop sales of 125 million bushels were the third best for any week on record and the best on record in weeks in which China was not a key buyer. New crop soybean sales were also strong, surpassing pre-report expectations at 20 million bushels. And we also saw net wheat sales for the current marketing year exceed expectations at 27 million bushels.
Let's go back and run through some of this. So you look at this is just individual weeks. In that week of sales, 3.2 million metric tons for new crop corn is absolutely fantastic. We're ultra competitive on the global export market. We've got the second best book of sales over the last 10 years. Brian, this is my question. So we're selling a ton of corn. We're competitive. I know people think the crop is huge. The average estimate ahead of this report is like 184, 185 yield estimate. There is a possibility that we end up trend or below trend still, in my opinion. That's not my thought, but it's you got to agree that it's possible at least that you end up closer toward like a low 180. If that's the case, and we're selling this much corn,
Way overdoing it.
We're way underpriced, right?
Yeah,
If that were to be the case.
Very similar setup to last year. Last year there was a very kind of a distinct event, which was it was dry in August, and so that dry in August definitely took the top end off the crop. This year it's been kind of one of those sleeper things where we maybe forgot about it for a little bit, but I still think it's something that comes into play in the next couple of months, is the overnight temperatures that we had and how quickly it's pushed the crop along. And I think there's, some stuff floating around on X, showing crops that maybe are 3 to 3.5 weeks ahead of where they should be developmentally because of that. So all this stuff, comes into play. And I guess it's one of those things where you think about a year ago, we really had that export business ramping up, and then that export business was ramping up as the crop was getting smaller, right? And then that really changed the trajectory of the market. And I think we're in a very similar situation. Joe, I don't know how the heck to handicap a 95 million acre crop and tell you the difference between 184 bushel per acre, 188 bushel per acre. I can't do that. But what I can tell you is, if all of this rhetoric recently has talked about 187, 188, I think there's even people throwing out numbers that we could be, in the 190s for yield.
Yeah. Oh, they're out there for sure.
Yeah. I think you're in the same situation as a year ago, where you potentially, I think the risk now is that we've overpriced in too high of a yield, then we're not pricing in enough yield. That's my opinion. And this is at a period where the demand, I mean, everybody on the user side that touches corn, whether it's elevating corn, feeding corn, exporting it, they're all making money. So I just think that we're at a point here where there's very good value for this product.
Now, to look at the opposite end of the spectrum here, new crop soybean sales are terrible. China still hasn't bought any. We're the worst new crop book of the last 10 years. It could change quickly when and if China returns, and I believe that they will return. But this is a drag.
It is a drag, but I think that there's still some kind of positive things going on with soybean demand in the big picture, and maybe China isn't buying from the United States right now, but their imports in the month of July were a record high for the month. They were up almost 19% on the year. And yes, it's coming from Brazil, but that number for the month of July was a little over 11 million tons. And so if we kind of say, okay, maybe on average, they're doing about 10 million tons a month, and the crop last year out of Brazil was 154 million tons. And now this year it's 169 million tons. So you've got an extra 15 million tons to deal with. Maybe that's an extra month and a half where the Chinese don't need to come to the U.S. because of that extra Brazil production. Well, last year they came in and started buying in mid-July, and then that's really when their buying program started. So, a month and a half away from that would suggest maybe by the end of the month of August, maybe as we get into early September, we start to see China come in and buy U.S. beans. But the fact is, they're buying a lot of beans. Their total purchases are very big, and they're using them up.
Yeah. To stick with the export sales and a trade theme, let's talk about the trade deficit.
So the U.S. agricultural trade deficit climbed to an all-time high during the first half of this year. According to the USDA, exports trailed imports by $4.1 billion in June, a 14% increase compared to June of last year. This pushed the agricultural trade deficit to $28.6 billion for the first 6 months of the year. For decades, the U.S. agricultural industry had consistently produced substantial trade surpluses. However, that trend reversed during President Trump's first term in 2019, when the initial trade war with China began. Since then, the industry has recorded trade deficits every year except 2021. Bumper crops in Brazil and Argentina have also made U.S. grain less competitive on the global market.
So we know that like corn exports have been fantastic. Soybean exports are not that great. A lot of this has to do with, you got to think about what we actually import that's an ag product. Most people would think, wait a minute, what are we importing in substantial size that's an ag product? It's just a matter of things that are considered ag products, fruits, vegetables. I think alcoholic beverages are considered under ag products. Trees, nuts, nursery stock, vegetable oils, sugar, processed foods, a whole bunch of stuff are included in the import category. Does this really matter, Brian? If we're shipping a ton of corn, I mean, does this matter in your book? I know people from a larger economic standpoint might say, yeah, this matters, but I don't know that it matters to our markets.
I don't think it does. I mean, I don't know. I don't spend a whole lot of my time thinking about trade deficits and how much someone else is buying and what we're buying. I really just focus predominantly on the pure balance sheet of each individual market. And I prefer to not talk about this slide anymore.
Yeah, I agree. Okay, let's keep going.
Alrighty, so USDA released weekly drought monitor data yesterday. Rainfall was spotty across the Corn Belt last week, with northern Indiana being the only area to see any improvement in drought conditions. Meanwhile, drought emerged in central and southern Missouri, southeastern Iowa, northern Wisconsin, and south central Kentucky. Only 2% of the region is currently experiencing some level of drought. Rainfall was scattered across the high plains as well, bringing some relief to dry areas in North Dakota, Nebraska, and Kansas. When we look at the percentage of U.S. areas experiencing drought, corn country 3%, soybeans also 3%, winter wheat 30%, spring wheat 35%, and cattle country 13%.
So drought is not the deal, of course, this year. We have very little drought. Here's a cool graphic from our friends at Crop Profit. We have essentially like no corn and soybean areas that are in extreme drought. We've got some moderate drought. We've got some abnormally dry areas. I think if anything, Brian, the issue right now could be that the Western Corn Belt in particular has been too wet.
Too wet.
You look at the rainfall in Western Iowa and in South Dakota over the last 7 days. You look at the precipitation rankings out of the last 133 years. This is July 1st through August 7th. You're toward historical extremes in that northeast pocket of Nebraska and a lot of Iowa. If anything, I would think that this might be the problem, if there is a problem at all.
Yeah, I mean, too much of a good thing, right? When you talk about when you grow a better crop, big picture, lots of water or a little water, and there's too much water, it'd be part of that equation. It puts a lot of disease pressure on the crop. I think you're going to see nitrogen leaching as a big impact. I've got a client out in that northwest pocket of Iowa, and when you look at some of the aerial photographs of some of the fields, I mean, you could just see it. That dark green turns into a light green and a yellow. From the aerial photography, you could see there's issues in the crop. So planting the dust, bins will bust, and you get just enough spoon-fed rain. That's a type of really good crop. When you really saturate the crop, I think there's negative impact to that as well.
Yeah, we're going to find out. And we've talked about, there's a lot of little issues that you hear about out there. Everything from the tassel wrap thing to now I'm hearing tip back to, I mean, all sorts of little stuff, some disease pressure probably. And we just don't know how widespread any of that is. There is in the forecast some heat. So we're going to be 3.5, 4 degrees above normal over the next 7 days. Rainfall is going to be mostly normal, but you get out to this 8 to 14. They're talking 6 degrees above normal across the Corn Belt and rain being reduced. I've always made this observation, Brian. I know what they say that, okay, soybean crops made in August, right? I've never seen the soybean market react to August weather the way that the corn market reacts to July weather. And this feels like another version of that. Like you've got kind of what should be a threatening forecast, you would think, but soybean futures don't care.
No, we haven't cared yet, but we'll see. I mean, it's one of those things where there's definitely been a kind of a yin and yang to the weather right now, where over the last month and a half, if there has been a lot of heat, it's been accommodated by moisture.
Yeah.
And then when we don't have the heat, tends to be when it's kind of been on the drier side. So again, I think these are all kind of sneaky things that are robbing yield behind the scenes. It's not like that, where it's 105 degrees and it hasn't rained for 2 weeks and it's just blatantly obvious that is, taking yield away. I think these are like little phantom yield menaces that are going to slowly take the top end of the yield off. And it's going to be one of those things where the market's going to figure it out probably well before the USDA acknowledges it on the balance sheet.
Yeah. All right. We talked about China earlier. Let's talk about China again.
So China plans to scale back its hog herd, with industry officials meeting in Beijing next week to discuss cutting 1 million breeding sows. The move comes in response to a significant oversupply of hogs and a sharp 30% drop in cash hog prices over the last year. As of the end of June, China's sow herd reached 40.4 million head, well above the typical capacity of 39 million. Officials are considering measures such as limiting slaughter weights and restricting secondary fattening to bring the market back into balance. A smaller hog herd would reduce China's soy meal consumption, an objective the nation is pursuing amid ongoing trade tensions with the U.S.
Mackenzie, this is like the third or fourth article along these lines that we've reported on probably over the last 6 weeks. It almost feels like a PR push, like from the Chinese government to like keep putting this out there. I just don't know if it's real or not. If it is real, that's not good. I don't know if it's real, Brian.
I don't know if it's real either. I mean, anything that comes out of China, it's tough to know
Yes.
what the real story is. It's always, to me, it seems like it's like, hey, we're going to tell you this, and then look over here, and then over here, we're going to do the exact opposite.
Yeah.
I don't know what the story is, but as long as it's not something, like we saw, and a lot of people will attribute the poor soybean values to the trade war initially, but let's remember that there was a massive hog liquidation event, right? We had disease in China. So as long as it's not something like that, where we're seeing absolute massive liquidation of the herd, and it's just like a slow, let's dial it down a little bit. I don't think it's too big of a concern. And again, we just saw what China's doing on their soybean imports, right? Again, we just showed you, or we just talked about how their July imports were the biggest for the month ever. So obviously they're continuing to really buy soybeans en masse.
Of course, we've got to keep an eye on China because they're such a huge consumer of everything. 31% of global soybean consumption, 25% of global corn consumption, and 19% of global wheat consumption. So it is worth paying attention.
Nutrien is forecasting robust fertilizer demand in North America, along with a healthy global potash market in 2026. The company beat Wall Street's second quarter profit expectations on Wednesday, which was driven by increased corn acreage that boosted fertilizer demand. Following record sales in the first half of 2025, the company raised its full-year potash sales forecast by 4.3%. The demand for fall fertilizer is projected to be high despite weak grain markets as farmers restore soil nutrients following this season's anticipated high yield crops.
They said, we expect to be in a strong market next year. And they also said, we see growers investing to protect their yields. Are farmers going to continue to spend the same sorts of dollars on fertilizer, Brian, or are they going to cut back?
I tend to think they're going to cut back. I would almost be at the opposite end of this argument, but what do I know? I've never grown a crop before in my life.
Well, they're talking their book.
Yeah.
I mean, to some extent, you would think.
I think it's. I mean, you're going to see a decrease in corn acres this year, and we're going to take away some of the fringe production that we had planted this year. So maybe with that being said, unless there's a really good increase in the value of new crop corn, I think this is going to be a potential where we had an awful lot of fall application last year. I don't see the same trend coming this late fall, early winter, but time will tell.
These 26 corns at 447 today. Nov 26 beans are at 1045. So you've got corn for 26 that's probably, I don't know, call it 30 cents below cost. Beans are probably still more than $1 below cost for next year. We'll probably lose some corn acreage. I don't know if it's going to be as substantial as some people think, though. I mean,
I think we should probably lose overall acres next year.
Yep.
See the total come down a little bit, but there is a definite, back and forth of acres, right? It was 95.2 this year. Last year it was 90.6 on corn. I think the year before was 94.6. The year before that was like 88, right? So it's like there is a back and forth on the acres. We should see a shift and see a reduction in corn acres. How much? I think it'll be the low 90s, but we'll start getting into those conversations a little bit in a few more months down the road.
I've got some interest rate news.
The Bank of England narrowly voted 5-4 on Thursday to cut its benchmark interest rate from 4.25% to 4%, the lowest in over 2 years. The central bank has been cautiously reducing rates since July 2024, when they stood at 5.25%. Conflicting economic signals contributed to the narrow decision, with the job market showing signs of weakness. However, inflation is expected to rise to about 4% in September, well above the central bank's target of 2%. Given the mixed signals, the central bank remains uncertain about the future path of rate cuts, emphasizing a gradual and measured approach moving forward.
This is a precursor to the forthcoming U.S. rate cut. There's a 90% chance that the Fed cuts in September. And I don't know if they should be cutting. I mean, none of the inflation targets have been hit yet. We're going to cut, Brian.
Yeah, I mean, I think the Bank of England doing this is just the first step. The U.S., we know that the rhetoric has been that we're going to see rate cuts here. I think it's an inevitability, and I would maybe relate that back to the equity market, that a lot of times when you get these big bull markets and you've had an increase in interest rates, it's the decrease in interest rates when that turn happens, that the money starts coming out of the equity market. So it'd be interesting to see if the equity market really holds in here as rates start coming down.
CPI, our most recent CPI print was 2.7%. That was the inflation rate over the last 12 months. And the Fed has always said, you know, our target's like 2%. I feel like they've quietly adjusted the target higher, and they're now comfortable with like a 2.5 to 3% type inflation. I don't know. What did cattle do yesterday?
Cattle futures had a fantastic day once again. Live cattle were 245 to 355 higher, and feeders saw gains ranging from 362 all the way up to 645.
Cattle market thoughts, Brian? Is it ever going to go down ever again?
I mean, yes. I think it's incredible. I was just looking at the August feeder cattle, and you know, it's on the board for a total of 13 months.
Mm-hmm.
The third month of its existence was the only month we've seen it lower on the month, and was down 20 cents that month. Every other month, feeder cattle have been higher in the August contract. It's been an absolute tear to the upside. There was another chart I put out there yesterday, a continuous feeder cattle chart. And this was kind of like, there was a bunch of lows that were scored. This, I think, goes back to like 1995. And then there was kind of an overhead line. And that overhead line we hit from underneath yesterday. So I don't know. Again, it's just a line. It's kind of the opposite of the lines that were hitting the grains, but it's that overhead line that we went up and touched from underneath. We're getting up into the mid 240s. A lot of my extension objectives of the kind of the breakout that we've had here this year measured up to the mid 240s. So I feel like we're getting close to maybe another area where we should see a decent pullback and maybe some profit taking, but we'll see.
Outside market's pretty quiet on Friday. Brian, thank you for joining us. Guys, have a wonderful weekend. We'll be back on Monday.